How did a guy with a laptop and an idea build a company that manages $500 million in assets? What's an easy and low-cost way to manage your investments? And how can you get frequent flyer miles when booking a hotel room online? We'll answer these questions and more on this, the 70th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment has cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. That's betterment.com/ROLLER. Well, we've got the 70th episode of this podcast as we quickly make our way to the 100th episode. I don't know what I'm going to do for the 100th episode, but it seems like I ought to do something special. I'll have to figure it out. I guess I've got about 30 episodes to figure that out. Today, got a couple things on the show for you that I hope you'll enjoy. First, I'm going to, a little bit of, I guess, editorializing. I'm going to talk about unintended consequences that came to mind as I was reading about interest rates, and we'll talk about that. Found a great tool where you can earn frequent flyer miles when booking a hotel room online. So I'm going to share that with you. And then we have Jon Stein on the show. He's the founder of Betterment. You've, of course, no doubt heard of Betterment. They're a sponsor of this podcast. They were a sponsor of the 31-Day Money Challenge. And I thought I'd have him on to talk about how he started the company and where it's headed, what it's up to, and how it can help folks invest, whether it's in an IRA or a taxable account or whatever. I've had a Betterment account for, I guess, a couple of years now, and so I'm very familiar with it, but I thought we'd have Jon on the show so you could hear firsthand what it can do for you. So before we get to that, though, unintended consequences. There is no free lunch, and this really hits me, I think, probably because as a lawyer, and particularly as a litigator, I'm used to folks presenting arguments that are very one-sided, right? That's what the lawyers, or at least I think most lawyers, think their job is to present cases in court and to only give their side of the story, right? I mean, why would you help out the other guy and make his arguments for him, right? And so, you get very lopsided arguments in court, whether it's a jury trial, a bench trial, you're arguing something in a motion, and it just drives me crazy. And I think the best lawyers actually embrace the arguments of the other side and then have a response to them, but they don't ignore them. I think it gives them credibility in the eyes of a judge or a jury. And I just think it makes their overall case more effective, even if you've got a difficult case. And living here in the Washington, D.C. area, I get to experience this sort of thing firsthand as we're just knee-deep in politics. And, growing up in Ohio, and maybe part of it too was, I grew up at a time when you had three TV stations and, of course, no internet. But, politics, just didn't consume us in Ohio like it does, at least today here in Washington, D.C. And so maybe that's part of it, but it just drives me crazy. This comes from all politicians, where they give you sort of just one side of the story. And a perfect example, I'm going to give you a couple examples of this. One is the Affordable Care Act. So, my view is that depending on who you are, the Affordable Care Act is probably either very good for you or not very good for you. There were winners and there were losers with the Affordable Care Act. Putting policy aside, let's put aside whether, our views of the healthcare system and whether we think the Affordable Care Act was good for the American healthcare system or not. Depending on your situation, it's either good or bad, and it could be a combination, right? And one of the things that I heard repeatedly during the debates and then even after the statute was passed was that insurance companies could no longer discriminate against you if you had a pre-existing condition. It always drove me crazy that they use the word discriminate, because it's not discrimination. It may be bad. You may not like it, but I don't think it's discrimination, at least not in any meaningful sense. But fair enough. That is one of the things the Affordable Care Act will do. If you need to get insurance on your own, and you have a pre-existing condition before the Affordable Care Act, depending on your circumstances, you either may not have been able to get insurance, or you may not have been able to get insurance at a price you could afford. With the Affordable Care Act, you probably can now. I think that's a very good thing. But that's only one side of the story. What's the other side? Well, the other side is someone has to pay for that, right? It's not free. And so who pays for it? Well, by and large, folks that are buying insurance that are young and healthy. They're going to, all other things being equal, going to pay more. And I always felt that in discussing this sort of policy, we ought to be able to discuss both sides of that equation, because there is no free lunch. You just can't snap your fingers, wave a magic wand, and give someone with serious pre-existing medical condition health insurance for the same price as someone who's healthy. It's just not possible, right? And it's not peculiar to health insurance. The same would be true for someone who wants car insurance and maybe they're a reckless driver and they get into a lot of accidents. You can't give them insurance for the same price you'd give someone who's a safe driver. You would go out of business. So, there's just no free lunch. And it comes up today in other ways. The minimum wage debate is another good example. And, there's this debate, should we raise the minimum wage or not? If we do raise it, what should we raise it to, and over what period of time? I think this debate is, at least a little more open. The CBO, the Congressional Budget Office, put out their analysis of raising the minimum wage to, I think, $10.10 between now and, I think, 2017. And what they said was it would lift 900,000 people out of poverty. That's a good thing. But it would also cost 500,000 people their jobs. That's a bad thing. But at least it's out there. Now, we can debate whether the CBO analysis is accurate, whether it was done properly, that's fine. But at least the good and the bad are out there, and it can be debated. And it is being debated, and it'll be interesting to watch it. But the fact is, if we do raise the minimum wage, it will have some negative consequences. Now, maybe we think that's the negative consequences outweigh the positives. Maybe we think the positives outweigh the negative. But the point is to get all of the relevant issues out on the table so they can be debated. And where this really kind of hit me front and center today was the interest rate issue. I was talking to someone about interest rates, and as you no doubt know, the Fed has kept interest rates artificially low. The interest rates are not if you just let the market decide interest rates, they would be higher than they are today. But through lowering the rates they charge banks, and then actually buying mortgage-backed securities and other bonds, the Fed has kept the prevailing interest rates artificially low. Now, the reason, at least the stated reason, is to stimulate the economy, and it can, in theory, have that effect. Some, I guess, on the more cynical side, think it's a way to keep interest rates on the U.S. debt low so that interest rates don't crush us. I don't know if that's cynical or not. It's certainly a consequence of what they are doing. And the day will come when interest rates go back up, and the U.S. debt will start to haunt us a lot more than it does now. But here's the thing: interest rates being kept artificially low, there are some good things. It certainly does stimulate the economy, and it makes investing in capital and in businesses easier, less expensive. It also, particularly if you've bought a home or refinanced your mortgage in the last few years, you've gotten a really low, historically low interest rate. I know my wife and I benefited from that, and that's great, right? But there are consequences. There's no free lunch, and so if you're trying to save money, particularly if you're in retirement and you're relying on fixed income investments, you've really, really been hurt. And I was looking at interest rates on savings accounts. I track those on the site on DoughRoller and update it every month. It's updated now for May of 2014. And I tend to track the online banks that are available pretty much to anyone, regardless of where you live. The best rate is under 1%. I think the best rate this last month was 0.95%. That was the best you could do. And, it wasn't that long ago when you could earn 3, 4, 5% on a savings account. And, you just can't do that now. And so there are consequences to what the Fed has done, and it can really, really hurt, and it can affect some of the decisions that we make. One example of that is in investing. A lot of folks, myself included, have focused on dividend-paying stocks because the dividend yield is higher than what you'd earn on a savings account. Of course, the risk profile is very different, right? You invest in a stock, you're not FDIC insured, of course, like you are in a savings account. But at the same time, you can also increase your capital if the companies do well, and over time the value and price of the stock go up. But these decisions that are made have real life consequences for us. And I get a little frustrated when I don't think they're being aired and discussed, at the national level in an open and honest way. Maybe I'm expecting too much. I don't know. Maybe it's just from living here in Washington. But the interest rates have definitely had both a positive and a very negative impact on folks. And I talk to folks, I get emails from people, some of who are very happy because they've refinanced their mortgage at a low rate, and some of them are very upset because they're having a hard time generating enough income, in retirement. And so that's sort of the state of things as they exist now. The reason this came up for me was I was reading an article on CNN about interest rates, and William Dudley, who is the Federal Reserve, he's the president of the Federal Reserve Bank of New York, had given a speech, and it was on 3 reasons why interest rates could stay low for years. An interesting article. And one of the things he said was that our future growth potential is declining as more and more people retire. So I don't want to turn this podcast into gloom and doom, but that was his view, among other things. The other thing, though, was bank regulations. After 2008, we had the financial crisis. Of course, Washington came in and does what Washington does. It overreacted, in my view. I don't mean in terms of bailouts. We could debate that. I think they probably did the best they could under the circumstances. But then they enacted just a slew of regulations that have really clamped down on banks. I think they were well intended, but again, there's no free lunch, and there are definitely unintended consequences. And one of them is that banks have to hold on to a lot more capital today. They can't lend it out and make money. They've got to keep it in their vaults, if you will, and hold on to it. Now, again, the reason is that so that they can handle the financial crisis. But the problem is now is that they can't use that money to make income, to make profits, to lend, and so it reduces lending. That's a problem. Forces the Fed to keep interest rates down lower to help encourage lending. It's like a never-ending cycle. Anyway, that's my editorial of the day. I'm not sure really what the point is, other than it was. I'm reading about these things in the news. I'm sure maybe you are too, and I thought I'd just throw them out there. If you have any views on all of this, hit me up with an email. Love to hear your thoughts on it, dr@DoughRoller.net. Okay, how about on to something that's actually practical? How about that you can use? Came across an interesting site called Rocket Miles, and it's pretty simple. You sign up, it's free, and you can book your hotels online through this site. Say, well, why would you do that? Well, you can actually earn frequent flyer miles through this site when you book hotels. And this came up as my wife and I have been doing some traveling, and I've generally found hotel rewards not to be all that valuable. And through Rocket Miles, you can earn frequent flyer miles on a number of major airlines. I was looking at Southwest, which is one of them, and it's very easy to use. And as I'm trying to build up miles for free travel, this site's been very handy, and it has major airlines. It has deals with Alaska Airlines, American Airlines, Frontier, JetBlue, Southwest, United, US Air, Virgin. And so I thought I'd share that with you today, particularly if you're, as we hit the summer months, if you're looking to book hotels, it might be a way for you to snag some frequent flyer miles. And I do have an affiliate link for this. Just go to DoughRoller.net/rocketmiles. That will redirect you to the site. That is an affiliate link, and how that works in this case is if you follow that link, book a hotel, I get a 1,000-mile bonus, and so do you. Those are my favorite kind of affiliate programs where I can, maybe I get a little something, but I can get something back to you, and that's the deal there. So you can check that out if you want to at DoughRoller.net/rocketmiles. And if you've used it before, love to hear from you. Let me know what you think, dr@DoughRoller.net. I'd like to hear what your experience has been. And actually, that reminds me, before I turn to the interview with Jon, I had a guest on from SoFi the other day, and I mentioned an affiliate link there where if you wanted to refinance your school loans and you went through DoughRoller.net/SoFi, SOFI, that's an affiliate link, but you would, in addition, you would get a $100, I guess, sort of bonus, if you will, once you refinanced your school loans through SoFi. Well, they reached out to me and they said, "Hey, how about we increase that to $250?" I said, "Yeah, that's a pretty good deal." So if you go through that link now, you should be getting a $250, bonus, if you will, if you refinance your school loans through SoFi. If you've not listened to that podcast, I think they're particularly ideal for people with graduate degrees who have loans from graduate studies. Probably not ideal for people with subsidized loans, but more ideal for unsubsidized loans by and large. But you can check it out and see if it makes sense for you. Again, the link there is DoughRoller.net/SoFi, SOFI, and that will redirect you to their site, and you can check them out. Hopefully it can save you some money on your school loans. Okay, with that, let's turn to the interview with Jon. So we have Jon Stein on the show today. He's the CEO and founder of Betterment. Jon, welcome to the show.
Thanks. It's great to be here, Rob.
Hey, Jon, appreciate your time today. And let's just kind of jump right into it. Why don't you give everybody a little bit of your background, and then we'll turn to Betterment.
I got started into this wanting to help customers make better financial decisions and live better lives as a result. When I was in college, I studied economics and human behavior and was looking for ways to apply that, and just kind of happened into finance. I never really planned a career in finance, and I learned a lot in the process. I learned about how banks work and investments. I got my CFA along the way, and I've been doing this for something like 15 years now. And while I was working for the big banks, I found that many of them were doing things that weren't in the best interest of their customers. No surprise, probably, to most of your listeners, but they were not well aligned with their customers' interests. And I saw so many opportunities to make it better, and the name Betterment really came out of that desire to make it better for people. And the original idea was to combine the simplicity of ING Direct and the clear value proposition with the smart investing efficiency of Vanguard, and to kind of meld those into a product that would be easy to use and get you great returns, net of costs, and all of those things. And that original vision is still true to our company today. We've evolved the offering. We've become more sophisticated over time in terms of the advice that we give and the goals that you can set up on Betterment, more sophisticated in terms of the tax management that we'll do for you, the retirement advice, things like this. But overall, our mission of getting people the best possible returns, net of costs, net of fees, and helping them make better financial decisions remains.
So why do you think, you'd said that banks oftentimes didn't have their interests aligned with their customers, and I know that probably resonates with a lot of people listening, but why do you think that is, and why did it take a Betterment to come in and try to address that issue?
The financial services industry seems to go through cycles in America, and I'm not an expert of history, but I try to read as much as I can because I'm fascinated by it. And at times, the financial industry kind of gets away from us and starts kind of getting too big for itself, and the profits in the late 2000s and even today grew outside of the sort of place that the financial services should occupy in the economy. And people became a little bit lazy and a little bit complacent who worked in this field. It was just so easy to make money and so easy to introduce a new fee, and the regulatory environment was really fairly lax, that there wasn't a lot of strong innovation. And I think it actually took the crisis in 2008, which is when I was just working on the early versions of Betterment, to wake a lot of people up to the time to the fact that it was time for some really serious changes. And it was in that environment of the crash and some of the subsequent anger at the most trusted financial and investing institutions that Betterment emerged as a new and better solution. And I think that all of that frustration that people feel against the old financial order is one of the wins at our back, because we are doing things in a new and a different way. And sometimes you just have to go through those cycles to get real innovation and start doing things a better way.
Yeah, yeah. I'm curious, when you started Betterment, before you started Betterment, you were working where?
I was working at a firm called First Manhattan Consulting Group in New York, and we consulted to financial institutions all around the country and all over the world. I had clients in Australia and Puerto Rico and Midwest and everywhere in America.
Yeah, and so you obviously quit that job to start Betterment.
That's right, and I actually started working on Betterment even before I went to business school, and I worked on Betterment and taught myself to code while I was in business school, so that I could build the first version of the website and have something to show to customers and show to investors. And we launched in May of 2010, just a year after I graduated from business school. I went to Columbia here in New York, and it's been a great growth story since then.
I love those kind of stories, John. Do you remember the first time you sat down at a computer and wrote your first line of code as you're trying to hack your way through a prototype of Betterment?
Absolutely, and it's funny that you ask, because we've grown so much as a team now. There are over 50 people working at Betterment today, and back then it was just me. I'm putting together a Betterment story for the team that has screenshots of the first version of the site that I wrote. And the first thing I worked on was it's on the advice tab of the site, and then we call it the projection graph, and it shows how your money might grow over time. Well, I spent probably 2 months working on the animation of that graph to get it just right, because I thought that was the most important thing. And it was really a showpiece for, to show people this is what we can do. We can make it simple. And it had the slider that let you move your money between stocks and bonds. At that time, it was a money market account and a stock basket. And that slider was core to me, and sort of playing with that and seeing the graph move was what really, to me, explained the promise of Betterment and the simplicity of it, that you could see the potential returns, but also the ease of use, all in that one graph. And that obviously is one of the images that I'm using and kind of telling the history of Betterment and conveying that history to our team.
I love that graph and the slider because it does I think show very easily the impact of your asset allocation choices and time. And also the fact that, returns aren't guaranteed. There's a range, and that's based on historical data, which may or may not repeat itself. But that's great that you programmed that yourself, because that's kind of, I kind of do that obviously on a much, much smaller scale, but I sit there and I was hacking code today and trying to get some things to work. And of course, I break things more often than I make them work. But fortunately, I'm not investing other people's money. So, when I break, it's not a big deal. But so were you, when you left the security of a job and you're hacking your code and you're trying to get Betterment up and running, you had to have some fears. I mean, when you think back then, what were the things that kept you awake at night? What were the things you worried about as you started on this adventure?
Back then, it was just me, and I remember asking my family if they thought this was a good idea, and they were always supportive, but I think rightly skeptical of the project. My professors in school, a few were supportive, and a few are still either on our investment committee today. Some great ones. But many more were really highly skeptical and said, "Why would you go into this industry? It's so difficult to start an investment company. Why don't you do something easier?" And I guess I've always relished a challenge. Back then, the things that I worried about were, is this a good idea? Obviously, I was building a product that I wanted. I knew that it would work for me and my investing needs. And I had opened like 7 different brokerage accounts, and I had lost money actively trading. One of the first stocks I bought was E-Trade, and I think I bought it at $20, and caught a falling knife and wrote it all the way down to zero.
Nice.
And I realized, I'm such an idiot. I know from my economics degree what the right way to invest is. I know from my CFA that I should be indexing and buying passive portfolios. But I'm still doing these stupid things, and that's just sort of human nature. Sometimes we think we're smarter than we are, and it was frustrating that no investment account would do all this for me. So I built it for myself to help me manage my investments better. And I started talking to people and trying to get a sense for whether anyone else wanted this too. And that was my biggest concern in those early days, was would this be an appealing product for people? And it was when I started getting my first partners and talking to people in business school who also wanted the product, and my co-founders joined. That's when I knew that we were onto something, and that we could at least get it off the ground. I don't think I knew then just how successful it would be, but certainly I had hopes.
Yeah, sure. Well, why don't you give everyone just sort of an overview of Betterment? What does it do? How does it help folks invest their money?
Customers come to Betterment and tell us about their goals. And based on those goals and the time horizons to them, and the goals could be things like retirement or buying a house or just building wealth, based on those goals and the time horizons to them, we recommend portfolios. We then manage those portfolios for the customers and manage them for rebalancing and dividend reinvestment and tax efficiency, and even try to make recommendations about behavior and automating things like automating deposits into your account, or if you're in retirement and taking income, how much you can safely withdraw from that account. So we automate the process, do all the management for you, and do all of that for really an incredibly low fee because it's all technology-based. It's all software-based. And as a result, it's very efficient.
Right. Yeah, you mentioned, like, for example, someone could have a goal if they're already in retirement and they're needing to generate income. And I take it that's not me, I haven't gotten to that point yet, but if for someone in that situation, they could pick that as a goal in Betterment, and Betterment would recommend a portfolio to accomplish that goal?
That's right. Betterment would recommend a portfolio for you in retirement, and based on your age, based on how long you want that portfolio to last, how much money you want to have left at the end of that time period, and then based on those inputs, we'll calculate and automatically withdraw to your linked bank account a safe amount every single month. So it's like setting up a paycheck for yourself that comes from your investments and automatically transfers an amount to you that means that you will never run out of money. And that's a pretty unique. It's the first product of its kind, and we think of it as a replacement for an annuity. The problems with annuities are that they lock up your money. Often they're sold rather than bought. Often they come with pretty high fees, and this is a really low cost way to understand how much is safe to withdraw for your money, from how much is safe to withdraw every month, to automate that. And to still have access to your cash if you need it. So the whole amount remains liquid and available to you, just like any Betterment account is.
Yeah, and I'm just curious, what do you guys view as a safe withdrawal rate?
It depends on the time horizon and how much money you have. There's a classic kind of 4% rule that's been thrown around a lot. And we find that 4% rule, especially in current markets where interest rates are so low, often leads people to ruin, often leads them to run out of money too quickly. On average and over time, the 4% is about what you can expect to withdraw from a globally diversified portfolio. You might even be able to withdraw a little bit more. The thing is, you want to be dynamic about it, and you want to adjust that amount up and down if market conditions change, and if your portfolio gains or loses value, and that way you can guarantee that you won't run out of money. What we found in talking to customers, and I find all this research really interesting, is most people are happy to adjust, even in retirement, they're happy to adjust their consumption based on real-world events. And people know that if the market has crashed and is at 50% of its value where it was last year, they can tighten their belts a little bit, and they're okay with that, especially if it means that they can keep money invested and more money on the table, as it were, to continue growing for future years. They just need the advice about how much is safe for them to spend, and that our model is dynamic and changes over time in response to your conditions and the market conditions.
Okay, so if I were in that portfolio with Betterment and the market went down, Betterment might adjust, at least on a percentage basis, what I could take out for the next year. Of course, I could choose to take out more if I wanted to.
Exactly right. Yeah. You don't have to follow our advice.
Right.
But the advice is there to make it really easy, and we find that most people do follow it. Something like 70% of our customers just take our advice, and that feels right to them, and they stick with it.
Right. Okay. Now, you mentioned fees and keeping your costs down. Why don't you just kind of cover for us what the fees are for folks that use Betterment?
Our fees are the lowest in the industry. They cover everything, and they're very transparent. Transparent's one of our core values. They range from 35 basis points, which is 0.35% at the low end, to 0.15% if you're managing over $100,000 in your Betterment account. So 0.15% to 0.35%. A fraction of what it would cost to, say, pay an investment advisor. And because this covers all of your transaction costs, all of your trades, all of your tax integrations and tax management and rebalancing that we do for you, it ends up being cheaper than you could even do this on your own, paying brokerage commissions. And because we have access to every ETF, and we're not dedicated to a single platform, like we're not using just Vanguard. We've got great Vanguard ETFs, but in certain cases, Schwab ETFs or iShares ETFs are cheaper and better. And wherever we can, we take costs out of the model to provide you the best, most diversified portfolio at the lowest possible cost.
Yeah. Do you see any changes to your fees in the near future?
No, we don't have any plans to change the fees today.
One question I get a lot of email from folks wanting to know, should they hire an advisor, and what's a reasonable amount to pay. I had one person email me about, I don't know if you're familiar with Dave Ramsey's endorsed local providers.
Yes.
Which, as far as I can tell, they basically sell A shares with front loads is best I can figure out. But my question is this: why is there, given low cost ETFs and mutual funds and low cost, I guess, service providers or what have you, like Betterment, right, that takes advantage of those low cost ETFs? Why is there still a discussion about paying 5 3/4 front load on an A share, or spending a lot of money on an advisor? I mean, I understand if you've got, if you're a family with, $1 billion to manage, you might hire, someone to manage your whole family, let alone your money. I get that.
Right.
But for the rest of us, for all the normal folks out there, why is this even still a debate?
I think that 5 1/4% that they're charging provides them with a lot of marketing dollars to be able to pay to sell those products. And unfortunately, a lot of financial services products are sold rather than bought. And it is a marketing heavy industry because the profits have been so big. They can afford to spend a lot on marketing. We spend very little on marketing. We get 40% of our customers through referrals and word of mouth. We get another 30% through just content that we write. We've got some writers who on staff who talk about financial issues and so on. So it's a relatively small part of what we do. Instead, we invest in the product and grow through keeping our costs low. But I think that's not been the typical model. It surprises me that people can still charge those kinds of fees and loads and get away with it. But I do think it's a shrinking part of the industry. I think in the future it's inevitable that almost everyone will be investing like Betterment, either with us or in other companies that provide that will in the future provide similar services, because it's just such a much better model.
Yeah. I'm curious. You mentioned that you're in the investments. When folks invest at Betterment, they'll pick the percentage they want in stocks and the percentage they want in bonds. That's basically the only, as far as at least from the goals that I've set, that's really the only choice you have to make.
That's right. We ask you a few things. We'll ask you about the goals that you have, and the type of goal that it is determines some of what the investments that we recommend are. So, for instance, if your goal is retirement, you're set on a different advice glide path than if your goal were a major purchase, like I'm going to buy a home in 5 years. And the term to that goal is important. So the type and term are significant. And then you're right that we'll make a recommendation for a portfolio, and you ultimately have control over the slider between stocks and bonds. So if you don't like our advice, you don't like our mix, you can become more aggressive or less aggressive. I say, although that process is simple and straightforward and relatively directed, there are 75 million investors in America, and there are 75 million unique portfolios available at Betterment, because everybody has different goals. Everybody has slightly different time horizons and needs. And because you have those multiple goals, and because we customize a portfolio for each one, or recommend a portfolio for each one, everyone's ultimate allocation is going to be slightly different.
Right. So why does Betterment use Vanguard and I guess iShares and Schwab ETFs versus mutual funds?
Exchange-traded funds, ETFs, are simply a great innovation and better than mutual funds. The reason that they're better is that on average they end up being lower cost, and they have some tax benefits. And the reason that they're lower cost is that there's competition. So in the old mutual fund, and by the way, exchange-traded funds are mutual funds. They're created under the same Investment Company Act of 1940. They're regulated in much the same way. The difference is that they are exchange-traded, and that is what provides some of the cost benefit because there's competition. So if you wanted to buy a mutual fund in the old world, you would go to Vanguard and you'd set up pipes, and I'm talking about like from our end, right, from a technology perspective. We'd set up pipes and we'd figure out a way to get cash into Vanguard, and then they would, put our customers into some funds or something and send us back the amounts once a day. And then if we wanted to buy Fidelity funds or Schwab funds, we'd have to build pipes to them to get them money. With exchange-traded funds, we just build pipes to the market, and we can buy any exchange-traded fund. And because there's more competition there over different indices, there's probably a half dozen pretty decent S&P 500 ETFs. And because of the competition, the prices have been driven down. And every year you see, Schwab undercuts Vanguard. Vanguard lowers its fees. iShares undercuts Schwab, and that competition has really led to a great thing for customers. And we, by investing our customers in exchange traded funds exclusively, are really taking advantage of this the great innovation in ETFs.
Okay. And all right, well, one thing I was thinking as I was preparing for this interview was, a lot of folks might be looking to roll over a 401k to an IRA, whether they're changing jobs or maybe they're going to retire. And so they've got choices to make. Obviously, Betterment's an option. They could invest directly with a mutual fund. They could hire an advisor. What do you think, are some of the factors that folks should think through in making that decision? And obviously, you're no doubt, of course, a fan of Betterment. Why do you think Betterment is a good answer for those folks?
The fundamentals when it comes to these investing questions, where should I choose, are almost always the same. You want to control the things that you can control, and you want to try to find the best possible net investor return for your assets, right? The way that you find the best possible net investor return is you want to diversify broadly, because we know that diversification improves risk-adjusted returns, and you want to keep your costs very low. And third, you want to try to manage your taxes to be as low as possible too. We at Betterment take care of all of those things for you automatically. So we're diversifying for you in an appropriate way. We're keeping your costs as low as possible, and we're minimizing your taxes through our sophisticated trading and tax minimization algorithms. You could do those kinds of things on your own through another service. It's very difficult. It's easy to make mistakes and so on. You can't really do it using mutual funds. You don't have access to the same kinds of tax optimization strategies that we do. And as a result, Betterment's just a great option for people who are rolling over a 401k or an IRA. We also, by the way, while we're talking about IRAs, we make it incredibly easy. We have a concierge service that our average rollover time is about 6 or 7 days, and the average in the industry is over 30 days. So we've optimized even in the rollover process to make it painless and better than what many customers would expect.
So how would someone actually do that? I mean, is there a phone number they call at Betterment, or how does someone, if they want to roll over a 401k to a Betterment IRA, what's the first thing they need to do?
The first thing they should do is sign up for a Betterment account, and right on the homepage or the summary page of their Betterment account, once they're signed up, there's a button that says rollover, and you can roll over from there. You can also roll over during the sign-up process. If you choose a rollover account when you're signing up, that'll start the process, and we will ask you all the necessary questions, like who's your 401k provider and so on, and that enables us to start doing the paperwork and so on our end that we have to do to coordinate with your provider.
I'm looking at that now. I've not rolled over a 401k recently. I don't think I've rolled one over even since I have to go back before Betterment I think launched. But I'm looking through the screens now. It's very easy to do, and I take it this all happens I don't need to talk to anyone. I fill out this screen, which looks pretty simple, and that initiates the whole process. Will someone eventually call me, or will it just happen without even a phone call?
We'll send you some emails with some follow-up steps, and ultimately, I think most of the time people end up calling us, or we'll call you if we need something, because there's usually something that comes up. Rolling over from each provider is different, but all these providers that have your 401ks, they don't want to make it easy for you to roll your money out. So they usually throw up some kind of a hurdle. We've gotten very good at dealing with those and helping customers through them. But we have customer service 7 days a week. There's always 365 days a year. There's always somebody here to answer your call and help you with any questions in the process.
Jon, don't you give your people some time off?
Well, we're not all here on Saturday and Sunday, but some of us are.
Okay, so you can roll over a 401k, but you can also roll over, I guess, transfer an IRA as well.
That's right. You can roll over an IRA to us, and we recommend people do that. You can take all of your old IRAs and 401ks and roll them all into one account. It becomes so much easier to manage, and is actually better for you because you get a better, more appropriate asset allocation that takes into account all of those assets.
Okay, and these are, we use the term rollover, but are these typically done through a direct transfer so that, like, if I were going to do this, I wouldn't actually take possession of the money?
Yeah, we do both. So it gets a little bit technical, but there are direct transfers where your institution sends a check to us, and there are indirect transfers where you can just withdraw the money to your bank account, and then your linked bank account, you just push it back into your Betterment account. Either way works ultimately the same. You're moving money, and oftentimes for our customers, the indirect method is actually the easier one because you don't have to do as much paperwork. You don't have to ask your provider to send a check and all of that stuff. You just make the withdrawal, and it's incredibly easy to do that and to make the deposit back into Betterment. And we reconcile everything with the IRS. We tell them that it's been redeposited and send them those forms so they know not to charge you the 10% early withdrawal penalty because they see you've redeposited it into an IRA.
Right. Okay, and so you have obviously traditional IRAs, Roth IRAs. Do you offer SEP IRAs?
We don't do SEPs. We do traditionals and Roths, and that covers about 90% of cases. SEPs is something that's on the roadmap.
Okay, and then obviously you have taxable accounts, which is what I have.
Yes.
With Betterment, portfolio construction. So I assume you have some kind of committee that is constantly evaluating exactly what stock ETFs and bond ETFs to use, and depending on the goal, what percentage of each.
That's right. We have a committee here of CFPs, CFAs, PhDs from Goldman and Barclays and JP Morgan who put together optimized portfolios for each time horizon and type of goal. And all of that thought and research goes into the advice that's available through our website. And we have that's our internal group, and we also have an external group of professors and practitioners of finance from some of the biggest money managers and banks and schools who advise on that investment policy. And we meet with them a few times a year just to review any potential updates or tweaks to the methodology, and they provide a good sounding board for us as well.
Okay, and do those decisions, those investing decisions, change very frequently in terms of again the ETFs that you're using and the percentages?
No, they don't change very frequently, and the reason is that they don't have to. The best investment advice is to be broadly diversified, globally diversified, and not to try to follow trends. All the data suggests that those who chase hot sectors or hot trends tend to underperform the market on average because they tend to get it wrong. They look at recent data and follow momentum or follow whatever's going on, and those kinds of strategies more often cost you money rather than making you additional money. So our advice doesn't change a lot, but from time to time things come up. Like sometimes certain ETFs are launched and have lower cost than others, and we want to swap those into the portfolio. And we do that in a tax efficient way when we do that, so that we're always looking out for really our customers' net returns and looking out for their best interests.
Okay. Do you share how much the amount of assets you have under management? Is that something that's public information?
Yeah, we file we're a regulated investment advisor and a broker dealer, and that's in our Form ADV. I can tell you today we have $550 million under management, and we expect to be over $1 billion by the end of the year.
Wow! You going to throw a party when you hit that big $1 billion number?
We'll celebrate it. I think it's good to celebrate significant milestones.
Yeah, sure. Why not? Well, I appreciate your time. I've kind of run through a number of different things for folks, but are there any questions I should have asked you? Anything else? So maybe things on the horizon you can share with us, or what have I missed, John? Anything?
Yeah, I think that we talked about the investment income product that we just launched, and that was pretty exciting. We just launched a new algorithm called TaxMin that does really intelligent lot selection and selling for our customers. And we put a new blog post up that showed an example of a customer who made a $100,000 withdrawal And with our sophisticated algorithm, it saved them $4,000 in taxes versus what they would have gotten at a normal brokerage, which would do FIFO as the sort of typical method for selling. This is kind of, $4,000 on $100,000 is a lot of money.
Yeah.
And this is the kind of stuff that we do for everyone, just as part of your, there's no additional fee for that. It's just part of your Betterment account. And we're doing even more. We've got more to come there soon. So pretty exciting stuff. I guess the other thing to note is that I think we have the most delightful user experience. So we spend all this time talking about, best returns and how we optimize this and that. To go back to my story, I started this company coming from a place of just seeing customers and their financial institutions not well aligned, and that customer experience and alignment is really important to me. And so we've invested quite a lot of time in making our sign-up process easy, making the statements intelligible, making everything transparent and user-friendly. So that's something that I think surprises customers perhaps most when they come to Betterment.
Yeah, it's a fantastic site to use. And so I couldn't agree more on the user experience. And I'll link to the articles you've alluded to in the show notes to this so folks can check those out if they want to. Okay.
Great.
Well,
I'll send you those links if you don't have them.
Yeah, that would be great just to make sure we're on the same page and I've got the right links, and I'll include those. And again, Jon, I appreciate your time today.
Thanks so much. It's great being with you, Rob.
Well, I hope you enjoyed the interview. If you have any questions, just shoot me an email, and happy to answer them as it relates to Betterment. One of the things that I enjoy about blogging in this podcast is it allows me to meet a ton of people. I met Jon, I think 3 years ago at a financial bloggers conference, and I've just met some great people, whether it's folks from Vanguard, Fidelity, just at hundreds of different companies. And, you interact with different companies and you get a real feel for that company's culture. And one of the things about Betterment, they are a sponsor of this podcast. So you may be saying, well, how'd that interview work? Did you, front him all your questions, and was this scripted? Not at all. You know what? They didn't ask me ahead of time for what I'd be asking them. And they just said, hey, let's come on the show. And I did my outline like I do for all my interviews and asked them all the questions to get you guys the answers you need to see if Betterment is right for you. They didn't ask for the questions ahead of time, nothing. And I have a lot of respect for companies that operate that way. And I think virtually all of the companies that I work with, I've had very good experiences. There have been a couple of exceptions, and when there are, you just no longer hear about those companies from my blog or this podcast. But for me, that has definitely been the rare exception. The companies that I've had an opportunity to get to know, like Betterment and many others, have been great to work with and to get to know and to watch them grow and hopefully do good things for folks. So really enjoyed having Jon on the show. And I hope you did too. And again, if you have any questions about Betterment, don't hesitate to shoot me an email. And again, you can check them out at betterment.com/roller, ROLLER. And that brings this show to a close.
Welcome to the DoughRoller Podcast.
That was the wrong one. Let's try that again. There we go. Man, you think I'd have this nailed down. Maybe when I get to episode 100, I'll have this technology figured out. Hey, you can check out the show notes to this show. Just go to DoughRoller.net/podcast70. That's podcast 70. If you haven't yet subscribed to the newsletter, you really need to. I got a lot of stuff going on in the newsletter. It goes out every Saturday at 7 p.m. You can sign up in about 12 and a half seconds. Just go to DoughRoller.net/newsletter. Appreciate an honest rating and review of this podcast. Please don't remember that musical mess up that just happened. But hey, I love honest ratings and reviews of the show. You can do that at DoughRoller.net/iTunes, which will redirect you to the iTunes page where this podcast resides. As always, shoot me an email. I read everyone and I respond to every email, dr@DoughRoller.net. Hey, until next time, remember, the absolute best thing money can buy is financial freedom.